right, so welcome guys. I'm here with Neale Peterson, the founder of Real Estate Investor Magazine. By the way, Neale is my mentor, is the person who taught me how to get into real estate and actually buy my first property. So Neale, thank you very much for this.
Absolute pleasure. Wow.
100%. So
thank you for the opportunity.
yeah, so I think before you even get into the interview today, because I just thought, okay, let me just ask you a few questions here. I wanted to tell you how much of an inspiration you are. To me and a lot of other people as well that you mentored as well. I speak to a lot of mentees who were mentored by you as well, and I can see their progress and where they're heading. And some of them are actually good people who managed to adapt to the new technology that's going on right now today because of your inspiration as well. So I wanted to just point out to you. So first question I wanted to ask you is, why is it the best time for people to invest in real estate today?
It's a very good question. And I think first and foremost, we know that interest rates are probably at the lowest that it's ever been for 50 years, or whatever it may be. So I think the first thing is that interest rates are low, and I think it's going to stay low for the foreseeable future.
Okay.
Unless something radical happens in terms of inflation, because the way that our Reserve Bank looks at it is to say, well, if it's all about inflation targeting. So if the inflation goes up, they say, oh, interest rate must curb that and bring that down. So I don't think that's going to happen because our economy is in a tough spot, and I think for the next 24 months, I think we still got, it's not going to be easy times, but it still is great opportunities, great benefits for investors to get in. So I think first and foremost that. But having said that, you still got to know what you're doing.
Okay.
You know what I mean? It's just not a matter of saying just jump into the market and buy. You still need to go around and look properly and assess each deal on its merit.
Okay.
And there's got to be good value return. So for first-time home buyers, yes, the timing is perfect, guys, but there's still going to be a little bit of a lag. So remember that there's been a high unemployment, businesses have shut down. There's a lot of people that are now going to be selling stock. You're going to see a lot of stock coming out to the market. So I think within the next 6 months, watch this space. I started off where I grew my portfolio really big was in 2001, 2002. And I say we're kind of sitting more or less in the same kind of position today, where we're right at the bottom of the cycle in terms of interest rates. So I think definitely within the next 24 months, but find those deals, it's a great time to get into the market. But really do your due diligence properly on each property. Look at what you're paying for, what you could get in potential rental returns, and also what you could sell it for capital value return as well. Okay.
Definitely appreciate that. But I wanted to ask though, talking about doing your due diligence properly, most of the real estate education out there is what to do, to know how to do this, how to do that. So can we talk about what not to do when you're in the market and you're looking for deals? Maybe you're a first-time investor, or maybe you're just somebody who maybe bought a home or owns a house and then they want to get into real estate investing as well. What not to do?
So that's also a very good question. And what not to do is to take all advice on face value. I'm dead serious. There's so much advice going out there. There's all these advices which are popping out the woodwork. And the thing is, what you got to do, or what you mustn't do, is just take it as that's real good advice. Verify that information. Double check it. Check it versus the major sources that information that you're getting is true. Because there's a lot of people selling property and don't get stuck into the sales spiral that it's time to buy, you've got to jump in now. If I don't buy today, I've got no chance tomorrow. It's not entirely true. Because there's a lot of real estate out there at the moment, but there's also a lot of bad deals.
Okay, yeah.
So you've got to be able to assess and do your reports, do your homework, do your research. You've heard it all before. It's the Lightstone reports in terms of what the actual market value is. But you should be getting a discount of around about 30% right now for an existing property. I also say it's not a bad time to get into new developments, because remember, your new development will only be transferred probably in the next 1 year, 18 months. And you know what also happens with new developments, Ezra, is that as soon as the building goes up, everybody says, oh wow, I want a piece of that.
Oh yeah.
And by that time, the prices have gone up. So phase 2 or 3 or 4 or 5, whatever, of that development, you actually get the upside of the capital growth. And there's so you may have paid a small deposit, But now you've got the time value of money.
Okay.
Where over that 12 to 18 months, so you've already secured your unit, your finance has been secured. But when you could have probably sell it for 20% more. It's probably gain capital growth. So
Sorry about that, but actually about the developments, you actually mentioned before that it's much better to buy from a developer directly and try to have a good negotiation there. So let's talk about somebody who has no idea, where to get started in terms of that. Can you just give us an over high level view of what the process should be when somebody's looking into this developments, because there's a lot of them right now.
Yes. So look, the first thing is price. Price is critical.
Okay.
It's much cheaper to buy now than to rent.
Okay.
Don't tell the renters. But of course, so we've seen obviously the rental market struggle, and I think part of the reason is that there's more buyers that have the affordability now to get a bond, whereas before they would have said, no, listen, I'll just rent. So I think that's a small portion. I think also that just because a lot of people, the unemployment issue, businesses have shut down, so there's been a lot of distress. So I think as a result of that, people cannot afford their rent, they couldn't even afford their bond, so they just don't qualify. If you talk to the banks, they'll tell you, and they don't promote this quite loudly, but there's been distress at the banks. But there's two sides. At the same time, they also want the upside, so they also have to ignite the market as well.
Okay.
So they've also got to be very careful about how they assess their loans and that kind of stuff. But I think the pricing area, it's all people say location. I say finance. So in other words, how much does that property cost? What is what interest rate can I get my finance at?
Okay.
And what could I possibly sell that property, the future value in say 5, 6, 7 years, or what is my rental going forward for that property? Because at the moment, I think your rental you probably won't get to equivalent of. It's going to be certainly a lot cheaper for somebody to rather buy than to rent right now. So yeah, so that's why the first-time home buyer is such a big market right now.
Okay, I see. Because everywhere you go, first-time home buyers, first-time investors who are getting 100% bond or 105% bonds.
Yes.
Okay, what's going on? I actually thought the banks would be a little bit more conservative right now, but they've been giving out money, which is funny. So you're saying they are a little bit having issues, but it's also both sides because they have to put the market in place. So I'm just trying to figure out exactly.
But especially in the entry level. So I think you're finding the first-time home buyer, somebody that's never owned a property, they want to put those people into the market. I think that's noble. I think it's fantastic, and we'll see with time. At the moment, the economy is remember, they're only going to take transfer their property maybe 12 months or 18 months time.
Yeah.
So we're hoping by that time, and I think the bank's also hoping, and everybody else is hoping that things would have picked up a little bit.
Okay.
The economy would have picked up, and we're in a bit of a stronger position, and those people that lost their jobs are back on their feet, or become entrepreneurs or whatever.
True. They have 18 months is a long time to learn new skills, get into the market and try different things, get a new job.
Definitely.
All those things. Okay, but it does make sense. Plus the unemployment that just came out last month. That was pretty bad. But anyway, let's talk about existing investors. People who say, okay, now I have a property or two, okay, and I want to scale. If somebody's looking to scale, what can they do? What would you recommend today?
Yeah, look at the first thing I would say. The most important thing, if you want to scale, don't buy all the properties in your own name, like I did. I bought 18 properties, all in my own name.
Wow. Okay.
18. Now it was that was in the early 2000s. So somebody said, "Wow, how do you get 18 properties?" So I don't know, I just applied for the bonds. So at that time it was a little bit easier. The bank systems didn't sort of match each other. So in other words, Nedbank didn't know what ABSA was doing, ABSA didn't know what Standard was doing, Standard didn't know what Nedbank was doing. But I went through a bond originator, and obviously it was slightly different at that time. So the first thing is to buy in a structure, a company. I reckon a company, some people say trust, there are arguments for and again, but I don't want to say what they are because there's not a one size fits all for everybody. It all depends on what you want to do. So I'm not going to get into that discussion, but certainly buy into a structure, because if you're in a company or a trust or whatever it may be, remember that you're only as good as the income and how that company is run. So banks look at that, because if they see 2 or 3 other properties in there, they can actually hold that as surety against all the other properties, and they can actually see all your assets in there. So a lot of it's got to do how you do your application, and you've got to be smart by using good partners that know how to do the application properly the first time.
Okay.
Because normally you find a lot of people doing that, they get rejected, they try again, they get rejected again, they try again, get rejected. If you get rejected, you're probably going to have to sit back for about another 6 months, because the banks have got all your stuff on record. And they talk to each other, the systems talk to each other. So they know what the one hand's saying and the other one who said yes and who said no and why. So normally find out if you can what the reasons there are. Normally the bond originator gives you that information, or the bank is also prepared to give you that information. Then you fix whatever you need to be fixed for the next 6 months. And then reapply again, but always keep it in a structure. It's a lot easier, and you can scale. It is possible.
Okay, so scaling is going to come from your structuring of your portfolio. That's what, in short, you say.
You don't want 10 properties in your own name. That's it. And there's also remember, you want to get the benefit of tax, because that's what happens because you want to get to the point that any expense that you have on whether managing the property or traveling, you're in Cape Town now, and that you can write that off because you're here to come and see your properties in Cape Town. So you need to fly and see that and do an inspection or talk to the property manager, whatever it may be. That's an expense which you can write off against the company. So any profits that's in there, that now becomes an expense. If it's in your own name, it doesn't work very well.
Okay.
Kind of,
and thanks for actually clarifying that and giving a practical example, because usually people say, okay, buy through a company, and then you ask why, and then there's no follow through with a practical example. So let's talk about one thing that we get a lot. Is people are always saying, I can't get into real estate because of finance, right? So either people who are asking, where do I get investors, or how do I find people who can invest with me if they don't have any finance at all, or maybe some people over leverage themselves, or maybe they utilize the entire affordability and then they're stuck. They're wanting to build up some equity in their portfolio before they can obviously buy the next property. So I just wanted to ask in similar terms to say, okay, what are the best avenues to raise finance today with the current market and economic conditions for real estate investors?
I think it's a good question as well, really good. And I think the first thing is you've got to make yourself investable. So what I mean by that, you as the individual, you've got to be a trustworthy partner that first of all, you're bringing value to this discussion. And either you're bringing a property that you worked hard at finding that property, and you bring that to an investor and say, look, I think I've got an extra deal, and let's run the numbers, and let's look at these numbers. It's 30% undervalued, estimates in a great area, talk about an exit strategy, in other words, how long you're going to be in and how much money you need. Be specific as to what you require, for how long that investment is coming, and more importantly, what is that investor going to get as a return.
Okay.
What are you giving me as the investor? Well, I'm giving you 20% per annum on this, and this is how the payment, we call it a term sheet in business, a term sheet where this is when you'll get your first payment.
Okay.
So you're very specific. Try and keep the vagueness out as much as possible.
Okay.
And most important, act on what you promise. Whatever you promise, make sure you deliver to those. And then you get a reputation out there for being a really good investable partner.
Okay.
And people will want to work with you all day long, because either you've got to say, what is the value I'm bringing in this whole transaction? Maybe it's if you've got a property management skill.
Okay.
Maybe there's something else that you could bring to the party, or you've got something in tech, or you're bringing something of value into that just makes it so much easier, more manageable, more profitable for everybody. Then it becomes, as everybody says, a no-brainer, but you have to get to the point of making a no-brainer.
So that's just all about adding value until it's value enough for somebody else to recognize, look, I cannot,
and trust,
well.
Trust in the individual,
Okay, so talking about trust, I'm not sure if you know Cardone.
Yes.
Okay. So
he's got some bad publicity recently.
Yeah. So I wanted to ask you. I wanted to get your point of view about the situation that is getting lawsuits for promising investors specific returns. I'm not sure if the law applies in SA.
Look, it does. I mean, look, we've had issues here in South Africa. I mean, it's not an American story.
Okay.
once again, you know, I mean, I've seen Grant Cardone stuff, and we're not here to work with Grant Cardone, but I think that, you know, to what you're really doing is he's bringing co-investors into, you know, I call it collaborative investing, whatever it may be. I don't know what his structure is, so I can't really say how, you know, what it is that he's offering. But generally what he does is he raises finance from investors, they then put it into a pool, and so, I don't know, they called some of it a scam. I don't know all the details of actually what happened. But I would be a little bit careful because you're not really in control. So as an investor, if you want to be a good investor, start out having control of your transaction.
Okay.
That's critical. I mean, I know other companies that do very similar stuff to what Grant Cardone is. But at least what they do is they say, guys, you're going to stay in for 5 years.
Okay.
You're going to stay in for 5 years. You're going to get a dividend back, you know, and this is when you're going to get a dividend.
Okay.
And this is when you're going to get your value return. And in many cases, what those companies have done, they've actually over-delivered on their returns. They've actually over-delivered. And most importantly, they delivered on their dividends and that kind of thing. I mean, there's a few companies like I can mention. You know, there's a company in Pretoria, I've forgotten the name, ShareMax. It was, and they through a broker network. I mean, they were offering brokers up to 28% commission. So with that kind of high commissions, you must know that's it. Your capital has been eaten away. And unfortunately, there was nothing left to go into the property. You know, that's not a smart move. So you've got to understand the numbers. Where's the money going? You know, what control do I have over it? You know, so it's a hands-on, a hands-off scenario. And I think certainly Cardone's, you know, you don't have any control. With these other companies, it's their reputation. You know, I mean, if they've done 30, 40 transactions, and they're starting to slip up on the investors, that's the last investor you'll see. They're going to lose their entire future income that's going to come from investors. So that's what's so important, to trust, you know, who you're signing up with, why you're doing it, and all that kind of stuff. You know, you've got to be careful.
And also be clear, as you said, with your term sheets and when are people going to get dividends, what's going to be happening between. Just be very clear and avoid being vague. Okay, I understand that, because when it's vague, then it sounds like you also didn't do a lot of planning from your side as well. So just to ask, if you say summarize, how do people avoid the losing reputation and being investable people? How do people what not to do to you know? What do you have to do not to become somebody who's not going to be not investable anymore?
It's like you watch people, what they do and how they do things. So I think it's, you know, when you're under that kind of spotlight, you see, first of all, I think that's quite a responsibility to take somebody else's money and not put it into the asset, because it's going into your bank account. It's not going into that company. They say they're going to distribute it there and they're going to give those returns. So it's going into, I don't know, I mean, I'm talking about the Cardone scenario now, where it goes into his bank account. And so well, I'll have so much here and what have you. We don't know what happens to that money. You just got to understand how it works. You know, generally in South Africa, if it doesn't go into a trust account of an attorney, then you're going to be concerned. You know, you've got to know, because you've got to be able to, and that's going to be accessed either by the developer or the owner, or the seller, you know, whatever, you know, how the distributions are done, etc. But it's got to go into a trust account, then you can at least audit and see where the money is. As soon as you put it into a private bank account, then, you know, obviously you don't know where to go. You know, so, but I think educate yourself on that kind of stuff first. You know, I wouldn't advise somebody starting out jumping into that kind of investment right at the start. You know, part of your education and part of growing as an investor, that's why we're doing this first time home buyers thing, is really to learn through that. And you know, I've made a lot of mistakes. You know, you can over leverage yourself at the wrong time, and COVID-19 can hit you. Who would have thought? I mean, here we're sitting in WBHO's regional office. I was talking to the head over here. He had 18 properties, but 10 guys didn't pay. Now, how do you get that 10 guys are not paying? They haven't paid him since March.
Yeah, that's
so
tough.
That's like, and so what do? You know, like, so you've got to make sure that obviously a lot of them got lower bonds, so they've gone back into their bond, got the money out, so they're funding it now over that period of time. But that's what I call school fees, that you pay for. But that's this kind of event that's happened now, has knocked a lot of people over. I mean, even the REITs market.
Yeah,
So,
I don't want to get into that too much, but one of the things that we discussed a bit before I finish up my last two questions here is, we were discussing, okay, we as investors were not ready for the pandemic. It hit 3 weeks, everything changed completely. And then there was a lot of adjustment that had to happen in between. So how can people become ready for the next pandemic whenever it happens?
That's a tough one. Look, normally you find, we had the last financial crisis, I think it was 2008. So 2008, 9, 10. They said normally a crash. And when you say crash, everybody says, mine's crashing. Well, let's call it a crash. Call it what you like. But let's call it a downturn. Let's call it a recession, whatever you like to call it. It's normally once in every 10 years.
Okay.
Yes, some people have the ability to see ahead and to spot it. I mean, I didn't spot the 2008. I mean, I over-leveraged myself right at the end. I mean, I was sitting with 46 properties, half of them which I bought in like the previous 2 years, because I really wanted to scale my portfolio. I want to grow. And I had 22 really good properties, but unfortunately the other 24 weren't that good.
Okay.
So unfortunately, the one obviously tippled the other. But sometimes I never expected that at all, And I managed to kind of recover from that. But it's a matter of look, you've got to get your stats. I don't think it's possible. I think what you've got to do is become a responsible investor.
Okay.
So what you have to do then, and we can look at the REIT companies, for examples. Now, they've got big portfolios, and they got hurt really badly. And they have what they call keeping their loan to values extremely low. So they don't go, if a property is worth, say, 10 million, they'll make sure that they've got a bond on it for 4 million.
Okay.
So they keep their loan to values very low. So in the time that you do need to access cash, and there is a crash that you can go, there is refinanced cash, so you make sure your properties are refinanced, that you're liquid, that you've got cash flow, that you've got funds which are accessible when you do not have cash flow.
Okay.
So that's the trick. The trick is to and to try and keep that portfolio flush with cash, that you can access cash when you need it against that particular asset. So you can source that and then fund those shortfalls for the people that are not paying now. Look, your bond value is going to go up there, but that's fine. It's you'll be able to afford it from the finance that are in there. So it's a little bit of financial engineering, as they call it, that you need to do. So that's really what it is. So and that's why I say you learn from the bigger guys, because they become very sophisticated with balance sheets and how they work those balance sheets against each other and borrow from the one company to the other. And so financial engineering. That's a short answer.
No, but it makes sense. It does make sense. And I mean, come to think about it, I think bond finance is much cheaper than all type of other alternative finance that you can get to, obviously put in your.
And another point I want to make, and it was actually Kiyosaki, Robert Kiyosaki, he said he gets most of his best finance in times like now when the market crashes.
Okay.
And he said people don't believe they can, as long as they can get a really good asset. And the reason is obviously he's got an exceptional track record, credit record, and also he's got assets that he can back it up with, and he gets cheap finance now.
Okay.
So the ability to be able to get that finance now, not everybody's going to be able to get it, because the banks look at you and say, but you only got 2 or 3 properties. But it's somebody like him who's got 1,000, they say, okay, well, we can see.
There's something happening here.
There is, yeah.
So let's talk about the guys who are saying, okay, now I'm in Cape Town, you see all these vineyards, all different places. Do they have good hotspots for real estate, like investment properties in Cape Town?
Oh yes, So, you know, I was talking about the entry-level markets.
Yeah.
There's a lot of sort of first-time home buyer, a lot of units coming on the market. If you look at areas like Parklands,
Okay.
Parklands, which is just sort of in Blouberg sort of area, it's close to the coast. I mean, you can buy properties there in 600,000. Yeah, we are in Pinelands. Just on the other side of Pinelands, there's a head office of Old Mutual.
Okay.
They're just literally on just down the drag here. So it's like a city over there. I mean, they've got 7,000 employees working there.
Wow.
Now, my first units that I bought, my first 22 that I bought, all Old Mutual employees were my tenants.
Oh, really?
So they all had good jobs, they could all afford, and that's how I managed to get 22 units.
Okay.
And paid on time, had no problems. Literally no problem. And it was because they wanted to be closer. Now, directly opposite where I bought for the first time, there's a new development, it's called Cardone Park, you might say so, but it's a multi, and they're starting their first units in the 500s.
Okay.
So remember, the entry level is where the demand's going to be now. Because there's a lot of people want to break into the market for the first. First of all, it's affordable, you know, and we've seen already. You look at like TPN stats in terms of where the defaulters are. It's always those in the higher end.
True.
It's not those in the lower end. I mean, they'll pay their rent first, they'll pay their bond first in the low end. They you know, respect that. So your risk is certainly a lot lower in that. So there's a lot of hotspots. So I would look at those areas up to $1 million. Like Cardone Park in Finance, like in Parklands. We can start going out. You can even find pockets out in, you know, close to Somerset West.
Okay.
So there's almost every area, there's little pockets, there's little areas, there's a lot of new developments. Woodstock is quite a hotspot, observatory. So we'll have to see where the whole sort of work from home thing goes. And then also your sub-segments. You know, a lot of prices have come down into your sub-markets. So people will say, well, we'll operate from a place like, say, Manus or, you know, or George or something, but my head office is in Cape Town.
Okay.
You know, that kind of thing. But so yeah, you've just got to be aware. You've got to be looking, and then you could look at the existing markets as well. There could be some good deals coming on. So yeah, there's quite a few. I wouldn't say that there's one or two or three or four that's ringing out. There's the hotspots. You've got to kind of seek them out, because as soon as you say hotspot, somebody goes right there, and then there's a queue of mile, you know, sort of over there. So you want to be the first one to say, yeah, well, I bought those 22 properties, and I bought directly from the developer. I know a lot of people pay double the money, probably be 2 years later for that same unit, exactly the same. So I know, but I mean, I made 300%, 400%, 500% return on those properties.
Yes.
And it was just timing.
So
it just came into that part, and that's why I said you've got to watch the timing in the market. It's not, now a lot of estate agents say, and I'm not anti-estate agent, I want to make that very crystal clear right up front. They say don't time the market. It's not timing the market. You know? And people say, when's the best time to buy? Well, it's now. Yes, if you find the right property, yes it is, but you need to find the right property. It absolutely is any time is the right time to buy. But I think also sometimes you've got to wait and say for this whole lag effect, you know, to kick in and then see what actually happens from there. Yeah?
So the waiting part is something that I still find it difficult, because, you know, I'm always on looking for the next deal, and maybe I'll let it as time goes on, I guess. But one of the things I wanted to also ask you is there's a lot of young people right now who are getting into real estate, especially from our side. We get people on 19, 20, like, you know, 70, millennials, and Generation Z as well. So what would your advice be to some of them? Because, okay, here's the thing right now. I was watching some stats, I think you've seen that too, saying COVID affected how a lot of young people think about their dream jobs. So we're going to assume that a percentage of these young people are not working, and then a percentage of them might be working. So what would your advice be to those people when they want to become real estate investors and players in the long run?
Excellent question. And you know, there's a lot of little niches in property.
Yeah.
Talking about just real estate per se in South Africa. That, I mean, this business is how many hundreds of thousands of years old, but I think that there's still niches here in the South African market. For example, now if you talk about investors, in America they call them bird doggers. Okay, which is essentially somebody that finds deals for you. So you don't have to do it. you get somebody else. Now, I mean, in the UK, you find them in, I've forgotten what they call them I know in America they call them bird doggers. Like the bird dog, they shoot the bird and then the dog picks it up and says, look what I found you. And he could have shot it from a long, from way back.
Yeah.
And so the dog goes and fetches it and brings it.
Okay,
so it's very similar to like somebody that finds the deals, like you say, where are the hotspots? Well, get somebody's bird dog, a young guy, that can learn about, that's how they become educated themselves. They can actually make money. Now, if they had to find a group of investors and say, tell me, what is it that you're looking for in a property? Give me all the criteria. What is the price range you're looking for? What kind of area, whatever you're they could go around. It's going to take a little bit of, running around, phone calls, knocking on doors, doing all that kind of stuff. But really getting a deal and bringing it a real deal, and then saying to them, if I bring you that deal, how much are you prepared to pay me as the investor? And I can tell you what, the investors will pay you all day long. I used to have a business card, I learned it from Delta Risk, and I got a few deals like that. Up in Pretoria, actually. And it said, I'll pay you 5,000 Rand for every deal that you find. And so I'm very specific, this is the kind of deal. And it used to be on my business card.
Oh, I think you gave me a business card before, I remember.
I think it was $500, I said dollars because dollars sounded better.
I remember, I think I still have the business card.
That's right. And so but you've got to be genuine, because you've got to be working that all the time. And I tell you, for not a lot of work, you could be, doing deals, making money, but remember, you're also learning as you are. So how do you do that? And through that process, that bird dogger, that finder, that property finder is learning, but also growing. And now I can say, well, I know how to do this.
So how do I do it for myself?
So now I can start build some cash flow, build a cash pile, and yeah. So that's just one example, because the asset and the value of the asset. I mean, people talk about flipping. I don't think it's the right market to flip. I think it is possible. But I don't think your returns are going to be that good. And I know there are people that do simultaneous transfers, like they buy it for like next to nothing. I'll give you 100,000 and it's worth 500. And then as they flip it to someone, I've got a property here for 200, I'll buy it because it's already still a bargain and another bargain. But I think what's happened, the banks have stepped in on that now. And also, in fact, they went to court recently that we cannot sell properties. It's not fair on the owner, because the bank's still going to go back, depending on the size of the bond, they're still going to go back to the original owner. They're going to want the money back, whatever the shortfall is. So they don't want to put them in a position at the expense of somebody else. So we've got to be careful with those kind of deals. But what I'm really trying to say, there's a lot of opportunity. There's a lot of informal ways without getting qualifications of doing deals and being entrepreneurial. We're an entrepreneurial country. That's the only way we're going to grow this country, is through entrepreneurs. We're not going to do through more big companies coming on board. It's going to be being smart, finding a niche, and being proactive.
True. So the last question is the masterclass that's coming, Virtual Masterclass with Indian Property Group and Remag. It's coming on the 14th. So what can we expect from this masterclass?
Yeah, look, we've got a bunch of experts there. I mean, there's just so much, I've seen there's a lot of information going around. And I think there's good information, there's bad information, there's bad advice and good advice and all that kind of stuff. I say listen to everything. Listen to every little bit of advice. So there's going to be some really top-notch people there. People that have obviously got credit, been in the market a long time. Listen to them all. But I think at the end of the day, to all these people, you listen, but make your own decisions. Don't put yourself into their hands. Weigh it up, verify all the information, and then you take action on that information. And don't take everything at face value. Challenge, ask questions all the time, ask questions, do your own research, and verify. There's a lot of sources that you can get that from, that you can learn from, and to verify that information. So there's a lot of experts. I think it's just so much fun. It's a great information sharing platform. And I just get excited by doing that and just giving people great value that they walk away. And if you can help somebody to get into the market, wow.
Yeah.
Even if it's your first property, which this one is aimed at your first time home buyer, that's fantastic. What we want to do is to get you your first property. Let's get it for you.
I definitely understand. And it's for free, by the way, right?
Absolutely, it is for free.
Sure.
And there's also a little guide that we produced. So you know, the first time home buyers guide. It's going to be attached to the real estate investor mag. And so yeah, there's good info, and it's going to be fun.
Okay.
And I think we're going to make it always fun.
100%.
It's got to be fun.
It has to be. Okay. So guys, if you haven't registered, you must go and I think the link will be below here. Go and register, and we'll see you guys on
Wednesday. Yeah.
On Wednesday this week.
Yeah,
I think it's incredible. I'm also looking forward to it. And otherwise, see you guys later.
But you're going to be there too, Ezra.
Yeah.
We got the Pope. I mean, this guy, look out for him. He's watching. This guy's going to be at the top soon.
Yes, thanks a lot, Neale. And yeah, I'm gonna be there, guys. And also, you must join us and like, share the videos, and also, you know what, anything else you guys need, just let us know. Otherwise, thank you very much, Neale, for the great day.
Thank you very much.